Well, good afternoon, and thank you for joining us today for the latest installment of the Origin Advisor series. The topic today is very topical, one of the largest turnouts that we've gotten for this series that we do, and we're talking about interval funds, state of the market, and emerging trends. The goal of this webinar is, if you follow Origin, you know that we lead with education. We're thought leaders in the real estate space. On the equity and credit side, we put out a lot of our thoughts about the market, where we think rents are going, the supply and demand side, the fundamentals of real estate, why we want to be in certain markets, et cetera. And I think the idea behind Origin Advisor Series is that we want to bring in outside experts that know their market inside and out. Sometimes we get the best and sometimes we don't. And I'm very happy to say Kim Flynn is the best in terms of understanding the interval fund market, closed-end funds, BDCs. I'm extremely excited that she agreed to join us for this presentation. And I think you'll be really interested in what she has to say about the market, especially with everything that's going on in the interval fund space. So briefly, I know most of the people that join these webinars are familiar with Origin. I do want to give a little bit of a background, but also I want to just do a little bit of housekeeping. Is that one of the things that we always do is answer all of your questions directly. So you'll find a little Q&A box there. You can go ahead and type in questions. And we're going to leave about 10 to 15 minutes at the end of this presentation. And we're going to answer all of your questions live. I don't believe we'll get to all of them. We do tend to have a lot of questions. But if we don't, we'll get emailed a copy of all your questions. And myself or Kim we'll reach out to you with those answers. So please find that Q&A box and use it. We want to answer the questions that are on your mind. So just briefly about Origin, if you're not familiar with our firm, we're based in Chicago. We are a real estate investment management firm. Started about 18 years ago as a family office for our founders, Michael Episcope and David Shear, to invest their own capital into the real estate markets. And they were traders at the Mercantile Exchange in Chicago. So non-real estate individuals coming into this market really thought about risk and return differently. And so eventually, like any other business, friends and family started to come along. And fast forward through these 18 years, we now have over 5,000 individual investors, and we partner with almost 200 RIA firms across the United States that are investing their clients' capital with Origin. We focus exclusively on multifamily, no office buildings, no shopping centers, just apartments. And within the apartment sector, we focus in what we believe are going to be the most high growth markets. Right now, it's kind of the smile of the United States. And we have deal officers throughout the country. So we just opened an office in Miami. We've got an office in Nashville and Charlotte, Dallas, and Denver as well. So we're fully ingrained in our markets. And then we invest across the entire capital stack. So we try to build, buy, or lend whatever's going to get the best relative value at that particular time. And so, like, why this conversation now? I think, why are we talking about, private credit? I think it's been on everybody's mind. If I've been doing this for about 18 years, then I've been in the sort of like the private real estate distribution. And private credit, interval funds, BDCs, like nobody really knew what it was. And now when I turn on Bloomberg and I drive into the office in the morning, almost every guest that they interview, what is your opinion of private credit? Well, why has it grown so much? I think private credit is not a new asset class, but you sort of had to be institutional to invest into it. And so what happened is the structures and technology have created a democratization where retail clients are able to invest in these asset classes, whether it's structured credit, direct lending, bank loans, real estate, private debt, et cetera, that's tended to have a better yield than investment grade with lower volatility than equities. So it was solving a lot of problems. But take the current market context. I get asked probably 6-7 times a day about private credit, withdrawals, what's going on with interval funds. And I don't want to jump too much into that because that's why we brought Kim onto this presentation today. But I think it's important to keep it in context when interval funds are developed with the purpose of having a proration. The idea that you want to protect investors that want to stay in the fund and not the investors that are necessarily trying to get out. So I think the structure is working exactly like it's supposed to. But the main thing to analyze is the asset liability match. Within that semi-liquid structure, do you hold semi-liquid assets? And so we'll get into a lot of that and more. And I'm glad it's becoming so topical. I'm glad we're going through a point of scrutiny now. And that's why it's so important to get to Kim. So Kim is the president at XA Investments. She's a partner at the firm and responsible for all product and business development activities and the fund's proprietary fund platform and consulting practice. She's developed an expertise in closed-end fund product development and is a frequent contributor to media and industry events, including interval funds, alternative investments, and the London-listed investment companies. Kim has earned the CFA designation as a member of the CFA Institute and the CFA Society of Chicago. She was previously the head of product development for Nuveen Investments. In her 11 years at Nuveen, she helped develop over 40 closed-end funds, raising approximately $13 billion in capital. In her leadership role at Nuveen, Kim was responsible for asset raising activities through the development of new, traditional, and alternative investment funds, including closed-end funds, ETFs, UITs, and commodity pools. Kim received her MBA degree from Harvard University, where she was a William J. Carey Scholar and president of the HBS Volunteers. And before attending Harvard Business School, Kim spent 3 years working at Morgan Stanley and has her BBA in finance from the University of Notre Dame. I feel like it was like when they were announcing Tiger Woods and they said, yeah, I get it. I think we get it, Kim. You're very smart, very qualified. So thank you for joining us today, and excited to hear your thoughts on the market.
Thanks, Mike. I've got 2 teenagers too, and they would remind you that I'm not all that smart in a lot of departments. But happy to be with you, and happy to be talking about real estate and interval funds, 2 of my favorite subjects.
All right, well, good. That's a nice intro. Welcome, and why don't we just kind of jump into it? I think people are surprised when they hear about the size and the volume and the trends of what's going on in the private credit market. XA Investments obviously covers this very, very closely. So can you just talk about maybe the private credit landscape, how much capital is flowing into it, what you're seeing on the horizon, et cetera?
Sure. So the interval and tender fund space now is up above about 250 billion in net assets, and it may not sound like a lot compared to mutual funds or ETFs, but this part of the market is really just getting going. It's probably late second, maybe early third inning, just in terms of the expansion of the number of fund sponsors, the different types of funds that are available for investors. The interval and tender fund structure really can house any type of private market strategy. And so it has a lot of room to grow. I think this audience is probably very familiar with REITs and BDCs, but there's limitations for REITs and BDCs in terms of what those product wrappers can hold given what they were designed to do. An interval and a tender fund, you can see private equity, venture capital, infrastructure, you can see direct lending. You can also see all sorts of different segments of asset-backed lending, structured credit, you name it. I think there's still a lot of white space for this market to evolve.
Yeah, I think so too. And one of the things I remind people about is they say, are interval funds new? I've been hearing about them a lot, and they're not. I mean, they were created in the same act that created mutual funds, which raised trillions of dollars, as well as tender offer funds. And then, of course, you had interval funds. And where mutual funds grew so exponentially is the idea of just diversifying assets in one purchase makes a lot of sense. The interval funds had sort of a liquid structure to them. And one of the ways I think about this is mutual funds, in a way, are constrained portfolios. So imagine that you're the portfolio manager of any mutual fund out there, and you believe that we should buy X stock, IBM. We want to buy more of it. We're highly convicted on it, et cetera. and you're receiving sell orders from your customers. Therefore, you have to sell IBM, which goes against what you want to do. So one of the things we understand about asset management and portfolio performance is discipline and staying invested for the long term. And once you've reached that point of your investment life cycle where you're sort of out of that accumulation phase and you're getting to the annuitization, you're looking for less volatility, higher spreads, and what you give something up to get that. That's called the illiquidity premium. And so I think it was just sort of a misunderstanding of how interval funds work. I like to say they got the dust blown off of them maybe 10 years ago. Some enterprising fund sponsors found it and said this is a good wrapper. And it's proven to be true. It's solving the problems for some people that we want to get from point A to point B with the highest Sharpe ratio that we can, highest return per unit of risk. That's what we're looking for. And I think that's what interval funds do. And they keep the portfolio managers invested and sort of releases that constraint. So I'm glad to see interval funds growing like they are. And, the growth trajectory is kind of hard to put your finger on because it's not necessarily opaque, but it's not as tracked as other, say, funds in the market. Can you talk about maybe new funds in registration,
Sure.
maybe even some big players that are getting in the space or thinking about it, if you're allowed to say their names, or where you think this is going in the next 5 years?
Yeah, I think the resurgence in interval funds in terms of people dusting off that structure and using it now to enter the private wealth channel, I think it coincided with the business ambitions and looking at institutional capital pools which are not growing at the same rate that they once did. So I'm talking about pension funds and endowments. And so managers of private real estate, private equity, private credit, they looked at the McKinsey and Bain studies that were done showing that the private wealth part of the market was growing at 20% compounded annual growth rates, and asset managers' attention then turned to serving the individual investor in a way that really historically they had not. And a lot of this has to do with how we save for retirement, and where wealth is managed in the U.S. And so the interval fund is just at purpose with respect to making accessible products that in the past you'd have to buy a private fund. So the growth that we're seeing in the interval fund space right now is about 25 to 30% compounded. There's a 324 different, interval and tender funds in the space. That's from 160 unique fund sponsors. So asset managers are now building fund complexes, just the way they have done in mutual funds and ETFs, in terms of trying to take advantage of the growth that we're going to see over the next 10 to 20 years. And so I think that growth is accelerated right now, just like sort of a gold rush as people plant flags in the interval fund space, and fund sponsors want to be there first. They want to be a valued partner to financial advisors in terms of the education to help advisors with adoption of alternatives. Because if you look around, alt adoption rates vary. Some RAs and some sophisticated wealth managers have been users of REITs and BDCs and other types of private funds, but I would say largely the overall rate of adoption of private market strategies has been below 3%. So there's a lot of room for growth, as advisors look to help mitigate some of the risks of what tends to be, for most Americans, is large cap equity exposure. So the interval and tender fund structure, because it's easy for advisors to access, it's part of the reason why the growth is expected to continue at 25-30% for the foreseeable future. And I think you asked about funds and registration. There's 324 in market today, but there's another 58 in the SEC pipeline. Those funds will all be launching in the next 6 to 12 months. The SEC is a little bit smaller than it once was, given the DOGE-related funding cuts last year. This SEC is very supportive of private market strategies being incorporated into retirement plans. And so even though the SEC, I think, is supportive and willing, it still takes a bit of time to get through that regulatory process to make sure that all risks are being disclosed appropriately. And so we're seeing, I would say, a bit of a step back for direct lending and corporate credit, but every other asset class, we're going to see new funds enter the market in the near future.
It's good. It's good summary, and I love reading these questions while we're presenting. Kim and I have been doing this a long time, and sometimes you have to back up a little bit. There is a question in the Q&A right now that says, "What is an interval fund?" So while I was thinking of that, Kim, it'd be good for you to summarize what an interval fund, which act it was part of, how you can buy one, but also like other funds we've mentioned in passing. You say tender. Can you explain what a tender offer fund, a closed-end fund? Is maybe a BDC as well, just like kind of concisely what they all are and how they're different from each other.
Sure. So, you're familiar with mutual funds and ETFs. Those are considered open-ended type products. They're also registered with the SEC under the 1940 Act. The interval and tender fund are types of SEC registered closed-end funds. It's closed-ended. It's a bit of a misnomer because these are continuously offered and actively sold. The interval and the tender speaks to the liquidity window that's provided for investors. If you're investing in less liquid or illiquid assets like private equity, it's difficult to package those things into a mutual fund, and you wouldn't really be able to do it at scale. And so these funds need to provide a liquidity window. An interval fund, while it allows for daily purchases, it only allows for quarterly liquidity, and investors are subject to proration. So that means if everyone woke up and decided to try to sell their shares at the quarterly redemption window, not everyone would be able to liquidate. You would be prorated. And so that's meant to protect shareholders who are still in the fund. It's also meant to provide liquidity in an orderly fashion. Interval and tender funds, I refer to them as sister structures because they're very, very close in terms of how they operate. Once again, it's an SEC 1940 Act closed-end fund. The tender offer fund is different from an interval fund in so much as the liquidity can be determined at any given quarter as to whether or not management and the board want to provide liquidity. So liquidity is more certain with an interval fund because it's hardwired from the get-go to provide a set or stated amount of liquidity, and then the fund has to honor it. The tender offer funds in practice operate a lot like interval funds, but if a tender offer fund found itself in 2008 or 2009 and it needed for some reason to stop providing liquidity, the tender fund could do so. The interval fund would not be able to stop providing liquidity because it's hardwired, it's mandated. So it's a subtle difference, but it's an important difference. In many other key features of the fund, these two types of funds are very, very similar, and they're sold in very similar ways. The one distinction that I'll bring for a tender offer fund is that oftentimes you'll see long duration private market strategies like private equity or infrastructure being built in a tender offer fund structure, whereas with interval funds, almost all of the credit-oriented products are built as interval funds, and most of those have a daily NAV. So therefore, a daily NAV interval fund allows advisors to purchase shares using the mutual fund ticketing platform that they're used to. It's a CUSIP based, so it's easy to access.
Yeah. So another way to say that is you could buy it with a ticker. So it's daily price, daily in, but then quarterly, i.e., intervals, where you can sort of get out of the fund, and it's mandated gating, right? It's 5% a quarter minimum, so the fund has to at least meet that. So, anyways, that's kind of an intro into interval funds. You feel free to call me, email me. I'll talk to you a little bit about it more. I think it'd be interesting to sort of look at the just the market in general. Like I know we talked about this a little bit, but sometimes it's nice to put graphics up there just to kind of show the size. And if you could just kind of talk about the AUM and where you're seeing assets, whether it be credit or infrastructure or private equity, or what's happening in the market.
Yes. So in the last 3 years, the interval fund market has just exploded in terms of the number of funds that are available. So advisors now have much, much more choice. But importantly, in addition to just having more funds to consider, these funds are now developing track records. So these structures have really only been used, as you said, for the last 10 years. There's a handful of early market leaders with track records dating back that far, but the majority of these funds are new. And as you see, only 54% of the market has more than a 3-year track record. So a lot of funds are sitting at 1 and 2 year track records. It can be hard to judge the fund if you're not able to see that track record. It's probably what leads to a lot of the flows in the last 2 years have been going to credit strategies, because credit strategies are typically sold on yield, and you don't necessarily have to wait for the track record to develop. Yield has been in demand. We've been in a higher rate environment, and the investor demand for yield is really an evergreen need. And so these products are able for investors that are willing to invest for an appropriate, call it 3 to 5 years. You can pick up incremental yield, you can pick up incremental return. And there are trade-offs there, because it's not a daily liquid ETF or daily liquid mutual fund. But that's why a lot of investors have started to incorporate interval funds into client accounts and into models. And these interval funds, the price point's a bit higher. Management fees average about 1.24. There are a handful of interval and tender funds that charge performance fees. That does create alignment, which is good, but it's just something to be conscious of as you take a look at some of the interval and tender offer funds out there. Typically, performance fees are associated with private equity or other institutional strategies where the manager is charging performance fees for individual investors, but also for their institutional clients. And the leading structure here today is the interval fund, because it's easier for financial advisors with that ticker-based electronic ticketing to use the interval fund and to size it appropriately in client accounts. So I think we're going to see further expansion of the interval fund side of the market.
Yeah, I do too. And I think we've kind of said this enough, so we'll just leave this up. I'll make a comment. If you want to add additional context, you can feel free to. But, obviously you're seeing most of all the new fund registrations and most of the capital being raised in interval funds in credit. It just seems like a really nice fit with a semi-liquid asset and a semi-liquid liability base for that asset liability match. There are some other unique asset classes that are out there, whether it's venture capital, private equity, infrastructure, and real estate kind of is a hybrid. Obviously, Origin has a private credit strategy, and when you look at real estate debt, we look at that as private credit, but of course we look at that as asset-backed private credit, where some of these firms, the cash flow, the coupon on the bond is essentially based on the full faith and credit of that company that issues the bond, and that EBITDA could go to zero for software and AI type companies. That's why you've seen some portfolio deterioration in some of these credit funds overall. Whereas with real estate, you sort of have an asset that can never go to zero, and that's the collateral behind the cash flow. So sort of a hybrid in there, if you will. And then I don't know, Kim, if any other comments. Otherwise, I'm happy to just move along.
No, I think, Mike, you're spot on. In our research team has identified asset-backed as being one of the hot areas in the last 12 months. So there have been a number of new funds formed, and I think it's in response to that demand for yield, but a pullback in terms of people's exposure to corporate credit. So that's why things like real estate debt, infra debt are in demand. And we've seen it across the interval fund space. And I think that because investors have BDC exposure, some of them have direct lending interval fund exposure, they are looking for other alternatives in credit, and having the collateral supporting the asset backed. I think that's been part of the reason why we've seen that shift.
Yep. Yep, I think so too. So it's been a good ride. It's been interesting to follow it from the beginning, and I think you're spot on with the growth and where it fits. And so, like, I guess that's the next topic is, a lot of this is education. We even had a question here: what is an interval fund, right? So, like, there is a lot of like, what is that? How does it fit? What are the liquidity mechanisms? And we'll sort of get into like all the traps of how it works in the next section, but. When I think about portfolio construction, it's no longer 60-40, right? There's an alternative component that has made its way into the high net worth retail channel, whatever you want to call it. And it's increasing Sharpe ratio. It's reducing risk, and it's increasing overall return. It's increasing income for retirees. In a lot of cases, it's tax efficient income as well. So it's something that advisors have to pay attention to, because the old model is not going to earn referrals and more business. Clients are looking for these type of strategies. So let's talk a little bit about how these funds maybe enhance, portfolio returns. If you're looking at maybe 60-40, where would you pull that from? What are alts, private alts? What percentage would they make up of the new portfolio? Versus, is this a hybrid, or is it just an alt in general? Like, how do you think about that?
Well, I think the best way to incorporate these types of private market strategies is to look at what the fund is delivering. So credit and the main benefit for investors is income. And so if you're looking for potential income substitute, you might be looking at your high yield portfolio, your senior loan portfolio. Maybe some products are investment grade, so you may be looking to substitute part of that investment grade fixed income portfolio. We actually have a whole subcategory of tax-free muni interval funds which offer incremental returns above mutual fund products. So I think that interval funds can be used as a substitute based on the objective. With respect to total return, if you're over allocated to US technology stocks, it might benefit you to consider private equity, because while private equity, typically due to valuation and the way those assets are marked, historically the volatility appears to be a bit muted or mitigated. So it could help reduce some of the equity vol that you have in a client's portfolio. So I do think that these are being layered in by express function in terms of what are they delivering: income, total return, or is it an inflation hedge? We've seen a lot of people incorporate infrastructure with continued concerns about inflation. Just this week, we saw another report that inflation remains persistent. So that's how people are using these. I think a question I often get is most of the underlying holdings in private or illiquid securities? And I would say largely interval and tender offer funds are dominated by private market securities. There is a new segment of the interval fund market that has quite a bit of public security exposure. So it's important for you when you're speaking with fund managers to help understand, what are the sources of potential return, what is driving that, and if some of the return is coming from public securities, you want to make sure that it's not overlapping with existing positions that you already have in your existing investments. So I think that interval funds can fit some advisors who historically have had a lot of exposure to real estate or to BDCs, have upwards of 20% in an alternative asset bucket. I would say that there isn't like a industry agreement. The industry has not coalesced around like a new 60/40. Partly because the use cases are different and we're seeing different behavior from different types of investors. So I think that it's okay if an interval fund sits alongside, for example, maybe precious metal holdings or crypto holdings. Everyone thinks about diversifiers differently, but we know that investors need more sources of diversifying return because so many people's portfolios have concentrated exposure in large cap equity.
That's a great point. We have to diversify return. And so you need to think about, what is your goal? I'm trying to generate income. I'm trying to generate tax efficient income. I'm trying to generate growth. And we're trying to get there with the lowest volatility possible. And so one way to think about it is, does this particular client have the ability to keep this asset illiquid? Do they need this portion of their portfolio 100% liquid 100% of the time? If they do, then alternatives and interval funds are inappropriate. If they don't, then as David Swenson from Yale says, why would you pay a liquidity premium for something where you don't need liquidity? So by giving it up, you get something else, and that's typically a spread. That's typically tax advantages, typically lower volatility, which is all things that we're going for. While you were talking, it made me think about qualified and non-qualified, which I can touch on, and then that kind of drives into, it got me thinking about defined contribution plans. So maybe you could talk a little bit about that, and maybe interval funds are the first step for DC. But a common question that I get is about interval funds are fantastic income generators for clients looking for yield throughout retirement, typically pay monthly cash flows. And so if it's private credit, you have interest income, which is typically, let's just call it 100% taxable. So a lot of those funds work fantastic in a qualified account. And then it's sort of another benefit that I kind of forgot to mention about asset back. So if you're a real estate debt fund, for example, because your lending is commercial mortgages, real estate, you can structure it such that you have a REIT blocker. So while you're investing in an interval fund, there is a REIT that will be part of the structure. And so you get the 199A deduction, which is part of the new legislation. So this is now codified. So you could think about income comes now on a 1099, which makes life very simple. And so if you got $10,000 of income in a corporate credit interval fund, you'd have to pay taxes on $10,000. If you got $10,000 of income in an asset-backed real estate credit fund, you could write off $2,000 of those taxes, and you'd only pay tax on the $8,000. The $2,000 is a permanent exclusion. You never have to recapture that. So pretty powerful from like where it sits, qualified, non-qualified. And then, any thoughts on getting these into defined contribution plans and more of these sort of sponsored plans?
Well, so with the Trump executive order in August of 2025, it really accelerated action in the industry, but also at the Department of Labor, which is ultimately what is going to govern what defined contribution plans do. There's a lot of litigation concerns from plan sponsors because you can be sued, for underperformance. You can be pursued for taking on too much risk. So it's fraught with litigation, which is why it's helpful that the DOL has actually put together draft plans for the incorporation of private markets into 401k plans. The proposal was focused specifically on target date funds, which is how about 80% of the industry saves for those types of retirement plans. And so incorporating an interval fund alongside other public securities in a diversified portfolio context, I think reduces the temperature or the concerns that people have about the lack of liquidity with private markets. So if it's in a target date context and it's being professionally managed over a time horizon which is fairly long prior to someone's retirement. So I think that there's a lot of enthusiasm actually from the Department of Labor. I actually just heard the Deputy Secretary of the DOL present, because they're energized by what the Trump administration is doing to push the industry, which historically has been reluctant to shift or change. So we have more space. We have some time before the final DOL rules. There's actually a push to try to expand the incorporation of private markets into other types of retirement accounts, not just target dates. That's probably where the debate is going to come. I think that most experts, I am not, I've just heard them speak about the fight's going to come down to whether or not we let retirees load up the truck and put 100% of their portfolio in private markets. And I think that's where people are concerned. They like it in a diversified target date, but I think there'll be objections, and there's a sort of protectionist argument that people make about trying to protect people from a decision that may or may not be appropriate. But I guess I'll take it back to that part of the business is a $14 trillion market, which is why everybody's talking about it. And there's tremendous growth, right? Because there's right now, the only dollars that we see in like CITs is actually real estate. They started working on real estate incorporating 15 years ago. So real estate actually was has broken ground with respect to being incorporated into retirement accounts by a lot of fund sponsors. So it's a pathway we can follow with other types of private markets. And I think we're going to see some movement. You've got some of the market leaders in the interval fund space, including Cliffwater and Stepstone. They've both recently hired dedicated experts that are defined contribution experts. Those are people that just joined their teams in the last quarter. So you can understand that we're going to see a lot more push in that direction.
Yeah, that's coming soon, and it kind of sounds obvious. And there's a little bit of this is being pushed onto the fund sponsor or the plan sponsors themselves. And these are very old, very prestigious type of companies that manage 401ks for large firms. And if this doesn't work, it's on them, right? Like so it's incorporated into a glide path, depending on your retirement age, with an allocation that's acceptable given your time horizon and risk tolerance, et cetera. Is that fair?
That's right.
Okay. Good. Yeah. So it's not willy-nilly. You're not going to be loading these into retirement accounts, but I do want them in mine. I have no access to private markets in any of my retirement accounts, and I wish I did. So I think it's a good thing. I just think it has to be incorporated intentionally, and I think the plan sponsors will do a very good job of doing that as we move forward. So. Good. So I think we've talked about a lot. We're kind of taking it home here. And one thing I'll mention is we are getting a lot of questions in the Q&A. So feel free to keep those coming. If there's anything in particular that you want to talk about, we're happy to address it. We just really wanted to get in some of the key considerations, and we're sort of, I don't know, getting into the details a little bit. I think, Kim, we've hit on liquidity a little bit, but when you're talking about the liquidity limitations and redemption mechanics, like what type of client profile is appropriate? How does that work? How should you think about an investor's timeline before allocating this as opposed to the ag index or something?
Sure. So I think that, there are some really good um, fund sponsors out there advocating that investors, they have to have the right time horizon first, which is a 3 to 5 year minimum time horizon, because much of the private markets, like the public markets, is cyclical. And the moment that if you need or want liquidity, it's not going to be optimal to pull liquidity from the illiquid portion or the interval fund portfolio. It's going to come at the worst moment in time. So you want to rebalance a public-private portfolio at a moment where valuations are true and there's less market turmoil. So we always think about, I think the question that people are asked, if you had to, or if you've needed to sell all of your securities on any given day, I think people they want the ability to liquidate, but practically speaking, they never do. So I think the challenge question is, if you're looking for additional return potential, this is the trade-off here in terms of liquidity. As you spoke about, the liquidity premiums for some investments can be 200 to 300 basis points. And a lot of investors are looking for that kind of pickup, but the trade-off is the fact that you won't be able to sell it on any given day. You've got to wait for a window, you're subject to proration, and it might be better for you to sell another part of your portfolio. So I think we start with liquidity because we want to make sure people are comfortable and they understand what that looks like. The flip side would be, a lot of this audience is probably very familiar with listed REITs and listed BDCs. Those are ways in the public markets to access real estate or access direct lending, but it does come with the volatility of those listed structures. And so that's a trade-off too. Interval funds and like private funds effectively have fairly low volatility because you've got stable valuation, and it's not, there's only the NAV of the portfolio. There's not a public price that could be higher or lower the way you might see a listed fund that trades away, like a BDC or a listed closed-end fund. There's a price and then there's a NAV, and those can be disconnected. With the interval fund, the NAV is always true and the price is always the NAV. So I think that's it's an insight it's relevant, because when you look at the shareholder statement that comes, your clients will probably not ask you many questions about those holdings, because there's an apparent stability in those positions. You might get questions, about some of the public equities where you are seeing that volatility. So investors have long looked to these types of products, and that volatility really translates into something that, if it makes sense for the client and it serves their objective, it can be a good complement to the public side of the portfolio. And I think a lot of advisors with discretion are looking to interval funds to serve as substitutes for a lot of those public positions that have more volatility than they'd like, and frankly cause more questions from clients than they'd like.
Yeah, you you made me think of a good point when you talk about like intrinsic value and where things are trading. We have, private REITs as well that are marked to market, and a lot of people say, well, why not just invest in the publicly traded REITs? And I usually just pull a chart, and they don't want to invest in them anymore. But when you look at a publicly traded REIT, the REIT, you can calculate the net asset value. All you need is the net operating income, and you can find out what the NAV is. Especially with AI, you can type it in Gemini right now. You can find out the NAV of every single publicly traded REIT, and then you could determine for yourself whether it's trading up, below, or above intrinsic value. And should you buy it if it's trading below intrinsic value? Maybe. The thing is, there's not necessarily a regression to the mean in public REITs. They trade on investor sentiment. In fact, there's not a lot of reason why public REITs move the way they do, and where they expect returns to go to is not usually what happens. And so private REIT is the NAV. We calculate the net asset value and we publish it. So public REITs trade on investor sentiment, whereas privately marked REITs trade on the net asset value of the fund. So it's actually more transparent, even though it's sort of seen as less transparent because it's private. So it's kind of the same thing with these interval funds. And I think you have really good look into what you're owning. And so like maybe I'll take the next question, but like market and credit cycle risks is like we're going through, like maybe think about that, because I think that's a large, people are saying, is it a good time to get in? Is the softness done? Of course, we don't know the answer to that, but it's an interesting thing to think about as we're sort of allocating. But when you think about investors and like suitability and education, requirements, obviously these interval funds can be traded on platform with a ticker symbol. You can allocate if you have allocation solutions through Orion or Black Diamond or Tamarack. They're very easy to put into client portfolios. And because the income tends to be higher than, say, you would get in investment grade bonds or something like that, I think we have to be careful that we don't just start allocating it to everybody. Interval funds are semi-liquid. They should be sold that way. And typically in the wealth management, portfolio management world, there's buckets. Like, this is the cash I need for the next 3 to 6 months. This is my 12-year capital. This is my 3 to 5, 5 to 7, 7 to 10, et cetera. And so as farther you get down that spectrum, you tend to have a higher net worth, higher risk tolerance, less liquidity needs, all that type of stuff. And so you can sort of give up that liquidity premium. I think it's super important. If I was a financial advisor and I was putting clients in an interval fund, I would say, if you can't pretend that this is illiquid for 5 years, then don't invest in it. That's how I would position it. Even though it is more liquid than that, you can redeem on a quarterly basis, et cetera. But I think investor education of how the fund structure works is super important because it is so easy to buy. In terms of what's underlying fundamentals or like what's in the portfolio, the nice thing is that these are 40 Act funds. So you can go to the quarterly statements on Edgar, and you could download every single bond that's in the portfolio, how they're performing, what price you paid for it, what price it's trading at. So these are super transparent portfolios, and could be potentially good options if they meet the client's risk tolerance, but it just needs to be explained how they work, how the liquidity provisions work, et cetera. The overarching theme there, Kim, is like, this is credit we're talking about. Credit moves in cycles. Obviously, infradebt is going to be different than corporate credit, different than real estate credit, but these are long cycles that should probably be diversified as well in clients' portfolios.
Yeah, I think so. I mean, the headlines recently have been largely about concerns around corporate credit, but there's so many other choices. If you're an income investor and you're concerned about, is this the right time to buy middle market direct lending? Maybe not, just given the correction that we've seen. But that's why there's it's the largest part of this market, because income is such a driver for consideration, and there's still white space in terms of fund sponsors that are developing new products, but there's over 120 credit funds in the market today because there's been such demand. And so the underlying assets for those credit funds will vary based on the investment manager's expertise, and the returns will vary too. But oftentimes we're talking about high single digit and low double digit returns. With credit, often the yield is basically the total return of the product. Some yielding products have additional upside potential. So it's something that every fund sponsor is going to be quick to talk with you about in terms of why this is an opportunity, why this is a great advantage. And I think it's worth exploring it a little bit more in terms of what's on offer, because if you're not interested in credit, and total return is more your focus, there's also a lot of other choices there. Some of those private equity funds actually have exposure to SpaceX and a lot of these unicorns. So we've had a lot more questions, a lot more focus on some of those names now that we see a couple big IPOs on the horizon.
Yeah, that's true. I mean, you've got a lot of those. So again, it goes down to access. People say, boy, I wish I could have had that SpaceX IPO or some of these other unicorns, and they're in these interval funds, which you can access. So you just have to research. Again, it's all public, but do your own research before investing. So I think that's a lot. We do have, quite a few questions coming in, and obviously, I just a little preface. A lot of these questions are about Origin and our specific funds and what the underlying assets are, and that's not necessarily the purpose of this conversation. So I will email you back if you're asking about our particular funds. Our email addresses are here. You can reach out directly to Kim or myself with any pointed questions that you have about your particular case or anything you'd want to talk about. But maybe we'll just jump into some Q&A. Kim, maybe I'll go first, and you kind of find a question on there that kind of makes sense, and we'll get to as many as we can. And anything we don't answer, we will certainly send you an email. One of the questions we got emailed in was, how do you protect against rising interest rates? I think the way that you need to frame that question is more like, how do you protect against moving interest rates? In other words, if we're a lender and we've got floating rate debt, rising interest rates are actually a good thing that you wouldn't need to protect yourself against. If we're a lender and we make fixed rate loans, then rising interest rates sort of are a negative to the portfolio. So of course, what nobody knows which way interest rates are going to move. We're very thoughtful about it and think about where we think interest rates are going to move, and we would hedge the portfolio appropriately using interest rate caps, interest rate swaps. We would also move the allocation of the portfolio to either fixed or floating, which would protect investors. But you want to make sure that you're set up for where you think interest rates are going to go using those kind of strategies.
And Mike, just to add, in terms of the interval fund space, structured credit and infrastructure are naturally floating rate and protected in rising rate environments, actually benefit from rising rate environments. So it's part of the reason why those two sectors of the market have attracted additional capital. So in addition to being an inflation hedge, a lot of the infrastructure assets have floating rate adjustments, just as you were describing for real estate.
Exactly. And maybe you could take this one. Just as, what do you think of the highly publicized recent continuing accelerated withdrawals from both public and private credit funds?
Sure. So, I mean, this started in September of last year when we had the First Brands and Tricolor news, and there were concerns when Jamie Dimon talked about cockroaches and potential bankruptcies in credit space. It continued on because we saw a lot of the non-traded BDCs being subject to requests for liquidity. We also saw the listed BDC part of the market trade off significantly, and that BDC market had been very healthy, trading at par, trading at premium. So it was a pretty big accelerated shift. And then going into February, March of this year, there were a lot of concerns about private credit associated with AI and software names, which is a big segment of the direct lending category. So it's interesting because we did see a couple of the direct lending funds in the interval fund space also hit with requests for liquidity as people were trying to rotate out. Most of the non-traded BDCs needed to actually gate and couldn't provide the full liquidity needs of shareholders. So I think when that happens, there's some growing pains in terms of the industry, because nobody likes to be prorated or nobody likes to be subject to a gate. And many times for new interval fund investors, this was their first experience with proration. So I think that we've seen it recently as we roll forward to Q2 redemptions. There have been continued high levels of demand for liquidity from direct lending interval funds. That is not surprising, considering that we're now in the third quarter of that demand for liquidity. And if shareholders were not able to exit, they now very much want to do so. So they're putting in higher amount of share requests to sell. So I think it will slow down. Right now, we're only seeing that concern hit direct lending and anything with corporate credit exposure. The rest of the interval fund market looks very healthy with respect to being able to meet liquidity demands from shareholders.
Yeah, I think that's a good summary. And a lot of this, like that's been my sort of answer, is a little bit of this is just overblown. The structure is doing exactly what it's supposed to do. It's amazing how Jamie Dimon can certainly move markets. He's earned it. He's been right quite a bit. But the structure is prorating and doing exactly what it's supposed to do. It's giving that portfolio manager the ability to know I don't have to liquidate these assets, and therefore I can hold with high conviction what I think I'm going to get. So if interval funds are appropriate for a client's, risk tolerances and needs and liquidity constraints, et cetera, it could be potentially a nice value add to reduce volatility, increase income, increase tax efficiency, et cetera. So a lot more questions are coming in. They're very direct to Origin. So I want to be just respectful of the topic today, and I will email everybody that's asking directly about Origin specifically. But Kim, I just wanted to say thank you so much. It's hard to find information about this sort of new and upcoming market. You are for sure a leader in the space, and really just appreciate your time and your insight into what's happening here. So thanks for joining us today.
Yeah, thank you, Mike. And any advisors can reach out to us. We do publish research specifically for financial advisors, and happy to be a resource for you if you're considering funds in the space.
Awesome. Well, thank you so much, and thank you everybody for joining us. We'll catch you on the next Origin Advisor Series.